And that perfectly leads into, what happens in a crisis. What happens in a crisis where you're in one of those bad markets and you need a little bit more money. You're an owner and you need more money, and you issue what's called a capital call, and you're asking for more money from investors. And this is super short, and it does highlight an important issue. And I think it's also worth going through the twists and turns a little bit of the first paragraph that they have here. It says, a public market downturn coinciding with large private market capital calls could force asset owners to liquidate assets at the worst possible time. Fortunately, capital calls tend to be highly correlated with distributions, which are typically depressed in downturns, dampening the liability requirements of mature private capital portfolios. Unfortunately, at the onset of severe market shocks, that correlation can break down, as illustrated by the spike in capital calls in March and I would say April of 2020, which is illustrated here as April 2020. And you see in April 2020 how infrastructure capital calls spiked, distressed debt spiked, senior debt spiked specifically. Infrastructure did spike. Real estate, it didn't spike. It spiked, but actually I was looking back. It looks like October of 2019 had a larger increase in capital calls in real estate. So I'm not really sold on that correlation there. But there is a significant amount of like senior debt, distressed debt, infrastructure, and even maybe a little bit of venture capital, arguably. But in that initial moment of the lockdown, the pandemic, it was very felt. It's like society, economy, locking down, and they're calling capital. And I could see why. It's really nervous. You don't know what the heck is happening. Especially in April, like you basically had like half of a month maybe to even just think about this. Maybe you were thinking about it if, earlier in the year, but it got really real really fast. And considering how slow moving the apartment investment market can be, things move pretty quickly at the onset of the pandemic. So things can move fast, especially I think if you're not set up correctly. And so this is where I want to create I think it's like sometimes I think I create like this perfect situation. Maybe it's not realistic, and this like hypothetical of distress, and their argument to return to this paragraph here. Their argument is that traditionally capital calls happen also when distributions are happening, which confuses me because I felt like if a asset is doing well and they're issuing distributions, then they don't need to issue the capital call. So there's a little bit of a logic jump there, and I'm not really sure. But if they have the data, then maybe you can prove it. And then I asked a couple people. I asked you, and I asked a couple other people at Great Capital. I asked the AI, and the AI was like, I guess I don't. So, but no one said they understood that.
No, the way that I can, I guess, wrap my head around it is in the event that during those time periods is, when you either would be doing distributions or you're doing distributions and they're nowhere near preferred return, really anywhere where you should be performing, that's when those capital calls are, I think, depending on the external forces and the market, it's when they're going to happen. And if we go back to 2020, I would almost frame that in a similar sense of the kind of extend and pretend that I talked about a while back when I was of the sense that the true extend and pretend was during the great financial crisis where the banks weren't really excited to take these properties back because it's not a matter of like, oh, you screwed up. The market's fine. We can find somebody else to operate it. It's these projects aren't going well because the world economy is crumbling. Yeah. In the case of COVID, you have a situation where if you're in a place like Chicago or quite frankly, just a lot of cities across the country at that point in time, your vacancy skyrockets out of nowhere. Yeah. And there's also the looming threat of March, April, May, and into the summer when you would have leasing season. Yeah. Chicago is a great example of it. All these people graduating from Big Ten colleges or Midwest colleges. Yeah. All these people that would have moved to Chicago to start their job. They either job never started because they didn't get it, or it was a matter of like, we'd love for you to start your job, but you're not coming into the office. Some of those kids still went ahead with getting an apartment because it was cheap. I don't know. Or some of them realized, why would I move to the city? Why would I do all these things when I can just live at home, It's not ideal, but at the same time, what's really not ideal is paying rent when I don't have to.
Yeah.
With that being said, from the operator's standpoint,
So,
your
so you think
vacancy.
they were probably also seeing really some real time numbers in their portfolio that's like, whoa,
Yeah.
this is a dramatic drop off. It wasn't just the vibes of, in which I would completely sympathize. As much as I make fun of vibes, it's like that I could see the start of the pandemic, but also having that data to back it up, where they see a bunch of vacancies. That's very persuasive.
You know, to land the plane that was my tangent.
Sorry.
I think it's a matter of just they had skyrocketing vacancy.
Mm-hmm.
The leasing cycle was going to be severely disrupted or non-existent.
Mm-hmm.
And there was that fear of, we don't know if there's a path out of here
Yeah.
or when it's going to happen. But also, if we're at 60% occupancy, we are not going to sell right now. We can't sell right now because
Yeah.
our valuations are going to go down.
Yeah.
They don't know when it's going to, and they also, on top of it, you have no idea at that point in time who the market's going to be. I mean, it was kind of, I would say, before interest rates plummeted. So there was that kind of the immediate sense of, we really need you to deploy capital and rescue, save, whatever term you want to use on the deal, because we're not going to have the reserves, or we might not have the income moving forward to keep this with us. But
Yeah.
also, we don't really have a great exit strategy. And I would have to think that at that point in time, too, the banks were like, we don't want to take on these assets.
Yeah.
Now it's a sense of, with these capital calls going on right now, it's a matter of, okay, the apartment demand, again, depending on what submarket you're in, as we've talked about, or what city you're in, it might, the actual apartment demand and rent growth numbers might not be where you want them to be. But for the most part, we are still
A brighter future than there was, at least in the early moments of the pandemic. We can see a way out now. Then in the pandemic, it was darkness ahead.
Well, you can see a way out, but also where you're likely getting a capital call right now is you did a value add project and you thought you were going to get a bunch of rehab premiums that you didn't get, or you didn't get near the amount of rent growth that you thought, or your expenses jumped that you didn't think, or bridge debt. So presumably somebody else can own this asset and do a better job than you, or they can just get it at a price that makes sense and they're moving on. There's a brighter future ahead. There's somebody that would want to own these properties, and people are bullish on the apartment market moving forward in a way that they weren't in 2020. These capital calls,
Agreed.
It's a sense of like, I don't want to give you more money to rescue something when you've proven over your 4 or 5 year, 3, 4, 5 year hold period that you can't figure this out.
Yeah. Yeah. And that
I mean, even the most experienced operators in 2020 faced, they had headaches.
Yeah. And that's like, maybe to repeat again, I think that's, what I've kind of coming to throughout the notes and throughout thinking this through, and all the reports that came across this week, is that a big difference between 2020 and 2025 is that the past was pretty stable in 2020, and the past was fairly unstable in 2025, or at least it was more vulnerable, more stagnation, more challenges for apartment borrowers.
I mean, if you include the Liberation Day news in the last 5 years, you've had a once in a 100-year, once in a century pandemic.
Yeah.
You had record inflation with large interest rate increases, and then you've also had
increase in tariffs that are even if you've taken the baseline 10%, which people aren't talking about but are still in effect supposedly, maybe, I think, that's like the tariffs as high as they've been in the 40s, since the 40s.
I was gonna. I'm glad you saved me there, because I was about to say I'm not a tariff historian, but I don't think we've ever tried to do tariffs at this level since.
Yeah,
I'd have to say that around the Great Depression when Hoover tried. So that's just been within the last 5 years.
Yeah, a lot of baggage, and a lot of baggage that perhaps they've been through before. If you're talking about maybe extensions that were made maybe in 2023,
right?
Maybe they had a 2-year loan in 2021. Now it's 2023. They get an extension because obviously that's weird. This once in a lifetime thing. And then 2025 may come around and they're like, well, you did this once before. Nothing happened. Great. Now next is a capital call. And I wonder, I think that the probability is relatively high, but I would love to know the numbers on if you issue a capital call, how much money you're going to get out of it. If you want a hundred million, or let's say 10 million from your investors, do you typically only get 8 and then you got to work on the other 2, or do you typically get everything you ask for? I wonder, and I don't always think that the alternative to a capital call is all the original investors lose their money. There's a scale. Some projects it may be that way, but there's obviously a scale of problems and solutions here that are going to leave more people in hot water than aren't.
But that was a great time to remind the audience that we've never had to do one of those.
Yes,
so
we never had. Yeah.
No, I think again to kind of put a frame of reference. I don't know. I wasn't in any capital calls in 2020, but I think you could probably get investors as scared as people were at that time and as uncertain as people were at that time of, hey, if it was not for this pandemic, it would be business as usual.
Yeah.
I don't know about rent growth targets, but we probably would not be seeing 40, 50, 60% occupancy.
Yeah.
Because people wouldn't be told to stay home or shift their way around, or I shouldn't say shift their way around, shift their way of life. Now, I think with the capital call environment, and I have not talked with a ton of investors or whatever that have had to really
that's
be in
another
any
thing.
of these. But
we only have anecdotes at this point.
Exactly.
Yeah.
I think there's a little bit of an element of, to go back on what I said, like, hey guys, the apartment landscape is fine. You guys as operators have just made some mistakes that have not been able to. You guys have just shown that you can't operate the asset.
Yeah.
And at this point, you're getting to a stage of like, even at 90% occupancy or levels where the deal should be performing well, you're asking me, or you're telling me that I'm facing the threat of losing money, and that I need to contribute more money to hopefully just break even in the end. There's also a possibility that you lose me even more money. I'm out.
Yeah. Yeah. It's really interesting, and what I'm wondering is that ever going to bleed into the strange idea that maybe they should just sell? You'll do capital calls, or maybe then you will get another line of credit, to help keep the deal moving along. And at what point does selling at maybe a little bit lower price than you thought become an option? And at what point does it become a necessity? Is going to be really interesting. And I think that now more than 2023, it may become a necessity for people. As much as we were talking up the beginnings of the multifamily market, like showing positive momentum, and I think things are coming in, that's just like, that's not going to be realized until 2026, and it may be a rough road in 2025.
Yeah, the equity component I don't entirely know, because with the equity, I think there'd be a little bit more of a buy-in of, we really don't want to do another capital call. And if we don't have to do that, I'm sure they're going to do whatever they can to skirt having to do a capital call.
Yeah.
Okay, yeah, we missed the target on a sales price, but in scenarios where your returns aren't what they thought, at the end of the day, if you're not losing money, people can swallow that. It's really going to come down to where the debt is.
Yeah.
Because a lot of these lenders are going to say, we've done the extensions, we've done workouts, this just isn't working. And if the valuations are such that the debt knows, at the very least, we will get paid back, which is all they care about. Yeah, you're going to start, people are going to be forced to sell.
Yeah.
It's great, and hopefully a lot of it's in the Midwest, specifically Indiana, Ohio, Kentucky, and Michigan. But
yeah. Well, and I think about this too, and I alluded this before I got caught up in something else. Is like, oftentimes I tend to maybe invent a borrower, that may or may not exist in the real world. I think we may be overhyping the fact that these capital calls are happening. We don't have the data. We've got MSCI that may have the data, and they wrote this. They wrote about capital calls right now. They're contributing to this conversation. They're making it more prominent. They're letting that's enough of a spark for me to want to discuss this on the Gray Report, is the fact that, well, MSCI may know what's up. They don't have they only have in this graph data going from like early or like late 2019 to mid 2021. So they don't have the current data on capital calls right now that they're showing us. Maybe behind the behind the paywall or whatever is data on capital calls that shows that they are actually increasing right now, because anecdotally we are just hearing from a lot of our investors that, yeah, no, I'm in this deal that they're asking for more money, and
that's why we can't contribute.
And that's why we can't contribute. It's like, all right, fine. But I also, again, like, I think about this worst case scenario of, and I wonder how common it could be, whether in all or in part, but all of these like kind of compound on each other. So is there a group of multifamily owners who maybe they borrowed with a floating rate loan where the interest rate has gone up? That's one. And maybe it was a value add project that has been challenged by rising expense and renovation costs. That's to go back to the CBRE. You see how it's a negative time to be a seller of value add projects if you're comparing them to different ones. And then also, we are in this extended period of high interest rates. Interest rates have not come down. And also, expenses, I said that, but low rent growth has also been a challenge, and that may not be happening. And then finally, not just nationally, they could have their value add, unfortunately timed loans for multifamily properties that were in specific markets that are going to take a while to come into balance. Like maybe it's in Austin or Phoenix or Charlotte, where it may take a year or two to even get to regular rent growth. Maybe the CBRE, the predictors, the survey respondents that were responding and saying that rent growth in Austin was going to be 2 to 3%. I don't know if that's going to be for all markets, and particularly it may not be for value add, but I can imagine a value add borrower that borrowed in 2021 with a floating rate loan that has, that's dealing with low rent growth and is located in Austin, Phoenix, like that may be a non-zero amount of properties, investors, companies. And so we'll have to wait and see if those opportunities emerge and how much they really move the market. Maybe the number's smaller than I think, but in a situation where sales activity is low, that may set prices in a more substantial way than if it were a more active market. Because right now it doesn't seem like much is moving. It's a big not yet that I said. But yeah, I think that the likelihood is that we could see a little bit of select drama and some good stories probably. But yeah, that's going to happen, at least the way that we projected it, and what we were trying to look at is, in terms of like the spikes and low maturities, is in maybe the second half of this year. In terms of like the specific timing, however, there are signs like I'm blanking on the name of the source, but I think it was CredIQ was showing that multifamily loan delinquency was going up, and they were showing there were also other signs of what they called distress, but was really just like servicing and delinquency, and not like technical distress. Mm-hmm. But these signals for distress were steadily increasing, and in a way that didn't jive with our earlier research that said that 2023 was the spike. No, the spike, and it may not be a spike, maybe a wave that's slowly building, has been building on the back half of 2024, and will be even worse in 2025. That's when the real exciting stuff comes for if you're going to be a buyer. But again, if you're a borrower, you may not get relief soon enough. That's and that's something that we've said time and time again. So maybe everything will work out, and there will be no drama in that case. I'll have to hang up my hat on the Gray Report, because I think that there's going to be some exciting stuff, and I'm pretty confident there.